and I apologize to you off camera for mispronouncing your name, and I'll apologize to you as well on.
Oh, thank you.
It's great to have you.
Yeah,
so I looked at the notes, and I was like, man, this guy's negative. He's really bearish. The likelihood of a recession is much stronger. We're soon going to have a credit crunch. And I'll save the doozy for after we talk about those two things. But you're pretty negative on the market.
Well, it's hard not to be. There's certainly a lot of things going on. But I think if you focus on what the Fed's doing, the way I see the Fed is most of their mandate is a Main Street mandate, where they're talking about full employment, stable prices. Those are Main Street things. And from that standpoint, I think they screwed up on the first one as far as the price stability. And they're making up for that issue. On the secondary one about employment, I think they're doing pretty well. I mean, honestly, if you're a consumer today, you've got a job, you got a raise, you're making money in the bank. You know, the numbers there are incredible. The Lakers beat the Dubs. It's all good.
Feeling really good.
But I mean, if you think about Wall Street on the other side, we've been in a recession since last year. 22 was an awful year.
Yeah, it's been like a rolling recession, right?
Absolutely. And I don't think that where the rubber meets the road really is this whole regional bank crisis that we're facing right now. And they don't have a lot of easy answers. You either have a NIM problem, you have a liquidity problem, you have an equity, you have a problem because you got to pay a lot more for your deposits, and you loan it all out in long-term mortgages. So, so there's no easy fix.
Don't invest in the regional banks. I mean, there are other areas. No, I mean, the policymakers continue to say, and I think John Williams himself with my colleague Sarah Eisen said it again today, that at least in their view, the most acute phase of that issue is done. It's passed, similar to what Jamie Dimon had to say a couple weeks ago. Do you disagree with that?
No, I think that early on in any cycle, you take out the weak parts of the market. So, I mean, we've seen the players that had mismanaged their books getting taken out pretty rapidly, and the Fed stepping in to make sure that the transmission mechanism works. Right, the banks are the transmission mechanism for monetary policy, and we get back to that Main Street, Wall Street thing. It's kind of where the rubber meets the road between the two, because that's where mom and pops is banking. That's where, and you got to treat them well. I mean, they're not going to pass up 5% in a money market because they like your tie. I mean, it's not going to happen. So I think that definitely has to keep working. I think they're going to. The reason why they're saying that the banks are sound and I'm tall and handsome. I don't. It's like the reason they're saying that is because they need to. It needs to work, and so they're going to make sure it works, Scott. I think if I were in charge of the Fed, I would give the regional banks a break on FDIC insurance. I just figure out a way to get that higher.
So it sounds like you're saying the idea of whether the Fed is done or not is irrelevant. They've already done a lot in a reasonably short period of time, at the fastest pace in 40 years. Yeah. That it's just starting to take its toll. Absolutely. So it's like the Druckenmiller thing we just listened to, where he is speaking at Sohn, and he said we're just getting a look under the hood. First it was the regional banks, and then in his words, quote, a lot more bodies coming.
Wow, I guess I'm very honored to be mentioned in the same comment with Druckenmiller, but yeah, it is early. It's early in the whole process of a slowing economy, and there's nothing that you can look at that would say that the economy is actually strengthening anywhere, except for the labor market.
But that's, right? Well, I mean, that's one of the most, if not the most important part.
Yeah.
Right? We're a consumption-based economy, 2/3. So.
Well, I get that, but I mean, if we get back to what Wall Street has to restructure to, it's higher rates across the board, a higher cost of capital. Everyone is, I think, impatient about this cycle because they're used to this V bottom that we've seen after Lehman, and that's not the reality anymore. I'm old. I started in the S&L crisis. This is going to take 2 or 3 years to work through. It's going to be like '99. That's the kind of distress cycle we're going in.